Hello, my name is Doug Greenberg, and I'm the founder and president of Pacific Northwest Advisory. Thank you for watching September's 5 Slides in 5 Minutes. Emotions can be one of our biggest adversaries when it comes to investing. It's natural to feel euphoric when the market is booming and fearful when plummeting. However, history and experts like Peter Lynch remind us that it's precisely in those scary, uncertain times when some of the best investment opportunities arise. When the market is soaring and everybody is optimistic, it's often a time to be cautious. Conversely, when the market is down and the outlook seems grim, that's potentially a golden opportunity to buy at lower prices. The key is maintaining discipline, not letting our emotions dictate our actions, and remembering that market fluctuations are a natural part of the investment journey. Just like we wouldn't panic because it's cold in Minnesota in January, we shouldn't panic when the market takes a downturn. Stay the course and consider those moments as potential opportunities, not just challenges. Credit markets will decelerate in the near term. Higher interest rates and the expectation that borrowing costs will remain elevated through late 2024 have had a chilling effect on the demand for credit, and this dynamic will persist through mid-decade. Performance will continue to normalize in the coming quarters. Delinquency and default rates will creep higher as growth slows, but for most products, performance will settle near 2019 levels. Significant credit stress is unlikely absent a recession. Over-tightening on the part of the Federal Reserve is the key risk to the outlook. Inflation is trending towards target, but has a ways to go. While we believe Fed funds rate has reached its peak, maybe there's a hike or two in the future. Policymakers have not taken those hikes off the table, noting that it will evaluate economic data as there's a risk that the economy could tip into recession. The timing between rising rates and slowing growth varies across the business cycle, and it's possible that tightening from late last year has yet to fully impact growth. Meanwhile, job openings in the US have surged to 9.61 million, signaling that employers are looking to hire. However, there's a shadow of uncertainty. If the economy doesn't perform as expected and long-term interest rates don't fall, we could face financial instability. All eyes are now on the upcoming employment report. Its results will likely influence economic trends and expectations for the rest of the year. Stay informed and consider how these shifts could impact your personal finances. Economists often face challenges in accurately predicting recessions due to the inherent nature of their forecasting models and the unpredictable, non-linear characteristics of economic downturns. Traditional economic forecasts tend to be rooted in linear projections, extrapolating current trends into the future. However, recessions are precipitated by a complex interplay of various factors, including sudden shocks to the economy, policy changes, or unanticipated global events, making them difficult to predict. Human cognitive biases also play a role. There's a natural inclination towards optimism and a tendency to underestimate the probability of negative outcomes. As a result, the economy's soft landing predictions often precede the harsh reality of a recession, underscoring the need for more robust, adaptable, and dynamic forecasting models capable of capturing the multifaceted and unpredictable nature of economic downturns. In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine as such. If investors can take advantage of good companies trading at attractive valuations, they should be rewarded over time. This chart is meant to tackle the issue of valuation from a number of different angles. The chart shows a forward PE ratio for the S&P 500 over the last 25 years. That is to say, the price of the S&P 500 divided by the annual earnings expectation at the time by the analysts for the following 4 quarters. We also include a box showing other valuation metrics. Year to date, valuations have improved significantly, but have moderated in recent months. That being said, valuation in general is a poor short-term indicator and should really be looked at in relative terms. The key takeaway is that while the stock market is below its valuation highs from during the pandemic, equities at the current moment look expensive relative to bonds, in my opinion. And finally, a discussion briefly on value versus growth. This page shows characteristics between value and growth investment styles. It shows relative forward price to earning ratios for the Russell 1000 value and the Russell 1000 growth indexes. When the line is moving up, it indicates that value is expensive relative to growth. But when the line is moving down, growth becomes expensive relative to value. How do we think about the trade-off between value and growth while we tend to think of equities as being cyclical or defensive? This page sheds some light on relative valuations and the sensitivity of earnings to changes in revenues. The chart looks at the relative valuation of growth versus value expressed as the number of standard deviations. This ratio is from long-term averages. You can see that in the run-up to the tech level, growth became materially expensive relative to value. On the other hand, during the global financial crisis, value ended up looking expensive as the financial sector's profitability, essentially was wiped out. Fast forward to today, and growth is looking expensive relative to value once again. Thank you for taking the time, and if you have any questions, please reach out.